In this video, we're going to discuss about the earnings per share concept in the income statement. So when we look at an income statement, the last line just below the net profit line. So when you see the net profit line, just below this, there is a line called EPS, which is nothing but earnings per share, right? What is this earnings per share? How do we calculate it? And what is the crux of this earnings per share argument, right? So let's try and understand EPS in income statement, calculation of basic EPS and diluted EPS. You will also typically see a number like basic, a name like basic, and another one called diluted EPS, and these are just below the net profit number, right? So let's first understand the concept of earnings per share, and then we kind of extend that in terms of what do we mean by basic and what do we mean by diluted in this context, right? So earnings per share is the net earnings available to common stockholders for a period divided by the weighted average number of common stock, shares outstanding, essentially. So in a sense, if you hold one share, what is the share of profits that you will get, right? Or profits entitlement that you get. It's not necessary that the company gives that to you. Remember, we've already seen in our business model that a company can choose to give dividends, may not choose to give dividends. If they choose to give dividends, then technically, if you hold one share, the profit that you can share out of it. So that's broadly the profit estimate that goes to each shareholder. If you hold a share, how much profit entitlement you have, right? Simple formula, you take the net profit and you divide it by the number of shares, total number of shares, right? There are firms, however, who have a little bit of a complex capital structure, and there you will result in seeing a basic and a diluted EPS. It's extensively used as a ratio by analysts in evaluating a firm. So it's a very, very important number that you will see across a lot of firms. Now, let's understand the difference between basic and diluted EPS. Basic EPS is just you take the total profit and you divide it by the total shares outstanding, right? Profit by shares, net profit by number of shares. In case there are different classes of shares. Now, for this, we will need to understand a little bit about what kind of classes of shares exist. So within equity, there is common equity, common shares, and there is what is called as preferred equity. What do we mean by preferred equity? These are guys who are typically given a definite dividend, right? So there's a definite dividend payment. So in a sense, they are similar to your debt kind of guys, because the debt guys also get interest, which is defined very clearly. So if someone gives me a loan, I'm going to give them an interest. If someone gives me money in the form of preferred share capital, I'm going to give them a definite dividend, right? So in a sense, this is like debt. This is definitely going to go. So you take your net income, from that you remove the preferred dividend because that's gone to the preferred shareholders. Only if something is left after that, that is what goes to the common stockholders. So common stockholders are last in precedence. If the company has any money left after paying the interest burden, after paying the preferred dividend, then there is some net income that is left. That net income minus preferred dividend is what is going to eventually tell you whether there will be any earnings per share or negative earnings per share, right? So technically that's the precedent structure, and hence the common stockholders will have the last say in this case, right? Sometimes, however, there are additional complexities that get added. The shares outstanding may actually change due to issuance of new shares. These shares could be through some sort of stocks that are given to the stock options given to employees called ESOPs. ESOP stands for employee stock options. Employee stock options are basically given to employees in the form of compensation, where they can convert it to shares. So they can convert it to shares and they become effectively more than employees, they become sort of shareholders in the company. Once they become shareholders in the company, they start working probably harder, they start giving more of their effort to the company because their work is going to define the profitability, and their profitability is going to define what is the value they will generate from their company, right? So a lot of the companies, in order to motivate employees, gives these stock options, and when they get converted, these are shares that will get added to the total shares outstanding, right? And there could be some other kind of securities. These are convertible securities, for example. So what is a convertible security? It is today treated as debt, but tomorrow at some point of time it can be converted into a share or number of shares, right? Based on certain preconditions. So effectively, these are some convertible securities which are available in the markets, and essentially these convertible securities also would result in change in number of shares. So the numerator remains the same, but in denominator, you have total shares, assuming the new shares as well, if you have to calculate diluted EPS. Why is it called diluted? Because the denominator increases. So diluted EPS is always going to be either less than or equal to basic EPS. It can never be more than the basic EPS. Why is that so? Because in basic EPS, you are taking net profit and you're dividing it by the number of shares. And here you're taking net profit and you're dividing by number of shares plus any new shares that can come in. So there is no way mathematically that diluted EPS can be greater than the basic EPS, right? So effectively, that's the crux of your argument around diluted and basic EPS. And how do you look at net income, preferred dividends, and total shares, assuming new shares as well? Let's take an example. We have a company whose data points are given. So all companies annually will report this, and in their annual reports, you will find these data points. Now, so profit for the period is given in rupees crore as 1229.85 crore, right? So if you want to convert it into rupees, you will have to multiply it with 10 to the power 7. Weighted average number of equity shares is 2 crore 71 lakh, right? So 2 crore 71 lakh 37,015. You find this, then essentially you're going to get the basic EPS as 453. That's the number we are getting here. In the second case, you are going to take 1229.85 multiplied by 10 raised to the power 7. That's diluted we are calculating now. Note A by D. So A divided by D. Diluted shares are nothing but these are the current shares outstanding, and another 99,768 shares can come. These are called as potentially dilutive equity shares on employee stock options outstanding, right? Why are they called dilutive? Because they will result in dilution or reduction in earnings per share, right? They will reduce the earnings per share for everyone because more shareholders are now sharing the same profit of the company. The profit is the same, right? And some new shareholders came into the picture. So you're dividing this number by the total number of shares, which is 272,36783. That will give you the number 451.54, right? That's the number of shares that's coming from B plus C. So shares here is B, this is C, B plus C is coming here, and then you're trying to find out. So if you buy a share of this company, you're entitled to 453 rupees worth of earnings on a basic basis and 451 rupees of earnings on a diluted basis, right? This is an entitlement, remember. This does not mean this money will be given to you. What money will be given to you would be the dividend number. Companies typically don't repay all the amount as dividends to shareholders because they would want to kind of keep in something for further growth, right? So simple. Let's take another example. A company makes rupees 500 crore in profits. Total shares outstanding is 25 crore, and it has also issued some convertible securities. Total convertible securities are 1 crore in number, but each can be converted into 5 common shares. The firm also has to pay 50 crore in preferred dividends. So let's first look at the numerator very carefully. The numerator is going to be net profit minus any preferred dividend. So that's going to be 500 minus 50. So 450 crore. That's what we're going to divide. In your basic EPS, you're going to divide 450 by 25 crore shares. In diluted EPS, you're going to divide 450 by Remember, 25 plus the number of new shares issued. 1 crore is the convertible security, but each of these will give you 5 shares. So 25 plus 5, that's going to be equal to 30. That's your diluted EPS, right? So we understand the concept of how do we calculate the basic and how do we calculate the diluted EPS. That's how it would look like. Net income of 500 crore minus preferred dividend of 50 crore. So numerator is 450 crore. Weighted average number of shares is 25 crore. You divide 450 crore by 25 crore, you get rupees 18 as your basic EPS. Now, if you're going to calculate the diluted EPS in this case, that's going to use the if converted method, which is basically you're assuming that these shares will get converted. Numerator remains the same, correct? But 1 crore convertible securities give you 5 crore new shares. That gives you the total shares at 30 crore. And when you divide 450 crore by 30, your diluted EPS is rupees 15. Correct? That is basically how you would go about projecting what is the basic EPS, what is the diluted EPS. These securities, like the convertible securities we had seen here, are typically called as dilutive securities because they will potentially dilute the earnings per share for each shareholder, right? It's an important concept in every company's balance sheet and the P&L that you see. The last item below the net profit number would be an EPS. So how do you calculate it? Take the net profit, divide by the number of shares. Diluted EPS, take the net profit, divide by the number of shares potentially possible to become available. Each company gives a table like this in their annual report. So you could also go and look at some more tables like this when you are trying to solve for the basic and diluted earnings per share, right? So that's broadly the construct of the data. Let's take another example. Now we are saying the company has 500 crore in profits, 25 crore number of shares outstanding, same as earlier. So 500 by 25, and we are saying there is no preferred dividend this time, right? So effectively what we are saying is straight away the basic EPS is going to be 500 by 25, that's rupees 20 per share, right? ESOPs could add another 1 crore shares. So the diluted EPS would assume what happens if these another 1 crore shares come. So by 26, and when you divide, that will be rupees 19 point something approximately. That's your diluted EPS that you have calculated. That's how you go about looking at earnings per share as a number. That's how you go about looking at earnings per share in terms of basic and diluted EPS, right? Couple of questions as we end this particular section video. Explain the difference between basic and diluted EPS. And if the total number of shares outstanding for Asian Paints is 96 crore and total profit is 1600 crore, what is the earnings per share for them? Thank you.